All right, part 3 for chapter 3. We're going to do the last category of adjusting entries, and it is called accrued revenues. So for accrued revenues, that's where we've earned the revenues, but we haven't been paid, and we haven't done the adjusting entry to show that. So we're going to be debiting an asset account. Typically, it's going to be a receivable, and we're going to be crediting that revenue account to recognize the revenue that we've then earned. So let's look at an example for that one. So on 12/12, Fast Forward's customer agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. We get to the end of the period, we have to do our adjustment. So it's 12/31. So we have 20 days worth of services that have been provided in the month of December. So 12/12 to 12/31, if you count it out, it comes out to 20 days. So that means we've earned 2,700 times 20 out of 30 days, or 2/3. So we've earned 1,800 of it. We have to recognize that revenue that we've now earned. Again, they're not paying us for it yet, so we're going to set up a receivable. So we're going to debit accounts receivable for 1,800 and credit consulting revenue, and this will recognize the revenue that we have now earned. So we have the T accounts that we show here. Our balance sheet's now going to show 1,800 that increased in accounts receivable, and our revenue increased by 1,800, bringing that revenue balance to 7,850. So remember, we said we're going to receive that cash in the future. So this is what the entry is going to look like when it's actually time to receive it. So we have here, we have accrued revenue that we had done the accounts receivable for, that 1,800. So on the 31st of December, we accrued revenue for that 1,800. We debited accounts receivable and recognized the revenue. Well, then we get to the 10th of January, and we've actually earned all of it now. So we want to recognize the other revenue that we've earned in the 10 days, and we're going to debit the cash account. So we've earned all of it now. So we've recognized the revenue for the 20 days in December. Now we're recognizing the other 10 days. So we have 20 days that we're going to be receiving cash for. So they're paying us now. So that's why you see that debit to cash of 2,700. So they're paying us for all of it. We've already recognized 1,800 of it in December. So we're going to clear that out by reducing the receivable, and we're going to recognize the other 10 days of revenue. All right, so for that one, that's going to show the cash that we received and the additional revenue and clearing out what they owe us. So now when we look at it, they're not going to owe us any money. All right. The next part we're going to look at is just looking at the trial balance. So in chapter 2, we had the trial balance where we had the list of accounts and their balances, and the debits and the credits had to equal. In chapter 3, we take it one step further. So we have the original trial balance, which we now are going to call the unadjusted trial balance, where we're going to list the accounts and their balances. Now we have two new columns in this worksheet. So the new columns are adjustments and then the adjusted trial balance. So the adjustments column is where we're going to record our adjusting entries. So the ones in the yellow to the left are the ones before we did adjusting entries. Then in the middle, under adjustments, we put our adjusting entries. Notice for every adjusting entry, just like every other entry, you have a debit and a credit. You have to record both sides of that adjustment. And then we bring over our balances. So we're going to look to see what the balances are after adjustments. So we call that the adjusted trial balance. So it's the balance after we do adjustments. So in cash, you can see that we didn't have any changes, right? We never adjust cash. So cash had a balance of $42.75 in the yellow unadjusted, no adjustment, so we bring that balance over. Accounts receivable have a debit balance of $0 in the unadjusted. We adjusted by debiting 1,800, and that means we have a new balance on the adjusted trial balance of 1,800. Then we have supplies. Supplies had a balance of $97.20 as a debit balance. We adjusted some of those supplies. We used them. We had that supplies expense down at the bottom for $1,050, and the other side of that was a credit to supplies. So we credited supplies for $1,050, leaving a balance of $86.50 in the adjusted trial balance column. So that's what you're going to do all the way down. So the adjusted trial balance just has us getting our balances, making sure our debits and credits equal after we do our adjusting entries. In Chapter 4, we're going to take that a step farther and apply those amounts into the financial statements. All right, and this is what we're going to kind of see. So from the adjusted trial balance, we can prepare the income statement using revenue and expenses from the adjusted trial balance. We can do the statement of owner's equity using capital withdrawals from the adjusted balance, and we pull net income from the income statement that we prepared. We can prepare the balance sheet using the asset and liability accounts from that adjusted trial balance, and we're going to pull that updated balance from capital that we got in the owner's equity. And then we can prepare the cash flows after doing that. And again, we don't go into detail in the cash flows in Accounting 1, but you'll get to see that more in Accounting 2. All right, so here's just a kind of summary of what we're doing with the adjusted trial balance. We're taking the balances and putting it on the appropriate financial statement. Remember, we have to do them first, income statement, second, statement of owner's equity, and then we're going to do the balance sheet. Next, we are going to look at the ratio for Chapter 3. It is the profit margin, and it's going to analyze how a company is doing by taking net income divided by net sales. It gives you some examples here using Visa's profit margin, and we can see that if we look at theirs, 2 years ago it was at 46%. Profit margin is something we want to be higher, right? We want a good profit. So the higher your net income is compared to your sales, the more profit you're making. So we can see that for Visa, they've actually decreased. They went from 46% down to 36%. So they've decreased 10% in 2 years. MasterCard has decreased from 39% to 31%. So they've decreased 8% in 2 years. As far as analysis for it, we just need to know how to calculate it by taking net income, which we get from the income statement, net sales, which we get from the income statement, and then we're going to divide. We're going to get our percentage. It's going to be expressed in a percentage, and we have to know that for profit margin, it is something we want to be higher. So a higher ratio is better than a lower ratio. All right, that covers our Chapter 3 lecture. So take a look again at any of the ones you have if you have any questions, and then also don't forget to look at all the Chapter 3 resources that are provided in D2L so that you have those examples.